Welcome back. This is Tony Mascali, your Elliott Wave technician, bringing you video number 4 in a series covering mastering of Elliott Wave theory. In this video, I intend to answer the question as to whether we are likely to enter into a period of inflation, a deflationary recession, a deflationary depression, or an inflationary recession, otherwise known as stagflation. First of all, just before I go into it, I would like to make this one comment, and that is that one of the reasons why I really like Elliott Wave theory, it is the only theory that gives me any chance of being able to make such bold and potentially accurate forecasts as what I'm making in this series. And it's based upon the fact that I know that this correction, based on the rules of Elliott Wave theory, will either be a flat or a triangle. So if my hunch it's a triangle, there's a 50% probability outcome, and I'm correct in my count that that's supercycle wave 3, and based on the rules, supercycle wave 4 should find support on this particular support line, which is a trend channel drawn from the 1932 low, being the wave 2 supercycle low. If I'm correct about those two assumptions, that means that that'll give me a 25% probability of being correct and being able to forecast these swings from here forward. So that means the initial down move of 4,000 in a Dow around late 2022-23, then back up to 16,000, then whipsawing swings back down to 6,500, then back up to 17,000, and back down to around 8,000 in 2036, and then a final rally for a new bull market to emerge, which will be the supercycle wave 5, and I anticipate that that will peak around 2060 at around 236,000 on the Dow. The Elliott Wave theory is the only theory that explains all the price action and actually can give you a roadmap forward. So, but if I need to update this count, I will put further videos up. But at the moment, this is my favourite count, and let's see how we go with it. So let's get into what this video is about. And there's a lot of debate right now as to whether or not, with all of the quantitative easings and basically money printing, whether or not there will be a debasement in the US dollar and inflation. There are some people calling hyperinflation, and I've heard calls of 100,000 on the gold price. Well, let's have a look at the gold market for starters. All right, here's gold in US dollars. This chart goes back to 1997. If you know the history of the gold market, in January 1980 it peaked at 875, which is about here. Basically it was in a bear market until it bottomed in 1999 and again in 2001 at around 250 an ounce, and then it took off. Spent a few years in a bear market between 2011 and 2015, and now it's resumed a bull market and is knocking on the door of the all-time high against the US dollar, which is around 1900 US an ounce. Okay, so what does that tell you? Gold is a traditional hedge against inflation, and gold is arguably predicting higher inflation in USA for the US economy. Otherwise, try and explain why it's appreciating against the US dollar. Some people say that that in itself, and just the sheer volume of money printing, has to result in a devaluation and hence some inflation. Maybe, but I think that's too simplistic. We've got to look a little bit further into it. The US dollar, what's it doing against other currencies? This is a US dollar index, which is the US dollar plotted against a basket of currencies. Mostly will be its trading partners, and it's not at all-time highs, but It's knocking on the door of the highest prices traded since 2002. So that's US dollar is knocking on the door of 18-year highs. It's testing the highs of the rally which commenced in March 2008. Ever since the GFC, the US dollar has been appreciating against most currencies in the world. It's one of the strongest currencies around since the GFC. Does that make any sense? The US has been massively printing and has been appreciating against most currencies in the world. That statement doesn't seem to be a statement that you can make, because under economic theory, any currency that prints without productivity debases its currency, all other things being equal, by the percentage that it has printed relative to its other currencies that you're measuring against. And that was the key in what I just said. What you've got to consider is not just what the US dollar and the US is doing in isolation. You've got to look at it, what it's doing in terms of the rest of the world. Well, let's start with what is gold. Gold is, if you like, it's a zero coupon currency. Gold's been a tradable currency for 5,000 years. You can take it anywhere in the world and it has a monetary value. You can exchange with it, but it doesn't pay a yield. We call it a zero coupon currency. In the past, it's been a disadvantage to hold gold because it pays no interest, and in the past, currencies paid interest. But what interest are currencies paying at the moment? Some countries are in negative interest rates. A lot of them are at zero. So interest rates are virtually negligible anywhere in the world at the moment. So all currencies are really zero coupon currencies. So at the moment, the thing that's determining the favoritism towards gold is that you can't print any gold. So gold is the pure currency that can't be debased. Because the US dollar is being printed and gold is not, that explains why the US dollar is devaluing. But what's it devaluing against? It's devaluing against one currency, which is gold. And why is it not devaluing against its trading partners? Well, you've got to consider the size of the US dollar, how much of it's in circulation, and what other currencies are in circulation, and relatively how much they are printing and how much is US printing. Roughly 75% of all the currency in circulation in the world today is US dollars. It's the world reserve currency. That means if it has 3 times more currency than all other currencies combined in the world today, for every $1 trillion that the rest of the world prints, the US can print 3 trillion for their one to be on a level playing field. That's the rest of the world cumulative printing. I'll give you an example that will make more sense, that is easy to understand. Let's just say that there's only 2 currencies in the world, and I had $100 in one currency and you have $1,000 in another currency. If I printed $100 in my currency and our terms of trade hadn't changed and all other things were equal, and you didn't print anything, my currency would debase by half against your currency. However, if you also printed $100 and you've got $1,000 in circulation, you're going to debase your currency theoretically 10%. But I've debased mine 50%, so relatively mine is going to debase on yours by 40%. So in effect, you've printed $100, I've printed $100, but your currency has gone up 40% on mine. So that's how a currency can appreciate against another currency while it's printing money. What we're saying here is that even though the US has printed trillions of dollars, it's printed less than 3 times the cumulative amount of dollars that its trading partners have printed. Henceforth, it's actually printed less relatively, it's stronger. And the reason why gold is beating everything else is because gold isn't being debased at all. If we now look at gold euros, and now we'll overlay gold in US. And we'll index them at 100 at the start. They both started out at an index base of 100. That means that if you bought $100 worth of gold at the end of, since 2008, it'd now be worth 192.6 US dollars, and it'd be worth 271.3 euros. In effect, in euro terms, gold's gone from an index of 100 to 271.3. That's an increase of 171.3%. However, in the US dollar, it's gone from an index value of 100 to 192.7, which means in the US dollar it's appreciated 92.7%. 92.7% versus 171 point something percent. It's roughly half. Since 2008, gold has approximately gained twice in value in euros than what it has in US dollars. And that's because the amount of euro that's been printed relative to its amount in circulation is more than the relative amount that US has printed relative to the size of the currency it has in circulation. That's the reason why gold's going up. It's not because it's pricing in inflation. It's just what you're measuring the US dollar on. We don't measure US in gold. We measure it against other currencies. Unless it devalues against its trading partners, it's not going to have an inflation problem. That explains that part of it. Now let's have a look at some other indicators. A reliable forward-leading indicator for recessions is the yield curve. In particular, whenever the 10-year Treasury bond yield has crossed below the 3-month Treasury yield in the past 100 years, has resulted in a recession followed approximately 1 year after it's gone negative. The only exception to this was in 1966, and what happened there is initially, the stock market crashed, a recession was called, and then later the recession ended up getting revised away. And that's because the technical definition of a recession is 2 negative quarters back-to-back of GDP growth. And what happened is one of those negative quarters was revised away to 0 later, and the recession was scrubbed off the history books. But for all intents and purposes, if this yield curve flips negative, there is a recession, or at least a serious downturn. There's the last 3 recessions, and this is the Philadelphia Federal Reserve publication. 10-year Treasury constant maturity minus 3-month Treasury constant maturity. So whenever that goes negative there, that means the return that you're getting on a 10-year bond is less than what you can get on a 3-month Treasury bill. And you can see here that last year, about middle of the year, it went negative. And if you remember the finance news, every time you turn it on, all they were talking about, interviewing economists about, is the yield curve's gone negative, this is indicating a recession, are we going to have a recession in 2020? And that's all they were talking about for months. And here we are in 2020, and the only thing we can say that's causing a recession is the coronavirus. Well, hello. The economy was shrinking before the coronavirus. One of the most reliable forward indicators had predicted a recession. The media was talking about it. Economists were warning us about it. And then everyone seemed to have forgotten about it in 2020. And it seems to be a surprise now that we're going into a recession. Well, we might come back to this chart, but let's just have a look at something else right now. And right, what does the coronavirus mean? Well, we're already slowing down. We're going into recession. The coronavirus has just compounded the problem. It's just made it all that more difficult for the Fed and the US administration. What we're looking at here is the St. Louis Federal Economic Reserve and the Atlanta Federal Reserve have developed their own indicators, forward indicators, for predicting GDP now. The St. Louis Federal Reserve calls theirs the Economic News Index Real GDP Nowcast. And the other one is just called, the Atlanta just calls theirs GDP Now. And the green line is the real GDP, as we have always known it. And you'll see there that the green line, there, the green one, which is the bottom one, at the first quarter 2020, came in at negative 4.8%. That's a pretty serious negative quarter of growth for one quarter. But the market's writing it off because it was a coronavirus. It was a medical problem, it wasn't a financial problem. The market's not even recognising a financial problem. And the media is only reporting about the medical problem. Have a look at what's being predicted for the second quarter. For the second quarter, the St. Louis indicator is predicting minus 46.7% growth, and the Atlanta is predicting minus 41.9% growth. I don't think we've ever seen quarters like that in history. That would be the whole depression of negative growth in one quarter if they came in at those kind of figures. Those figures are just absolutely deflationary. They're certainly not inflationary. Let's go back to the charts. We'll put that back to regular. We'll get rid of that one. And we'll change that one, and we'll have a look at 30-year Treasury yields. Here we go. So this is yields, not bond prices. Just expand that, get my drawing tools out of the road. And we can see there that this chart, it goes back to 1987. Bond yield started at just over 10% back in 1987. And they just bottomed at 0.8 and they're currently at about 1.4. And since 2008, they've gone from 5.5 down to 1-ish. Now, what determines the rate of a 30-year bond? It's not the Fed funds rate. The Fed has no influence over yields out in the 30-year area of the curve. Basically, that's determined by whatever the investors want as a risk premium above inflation, their perceived average inflation rate over the next 30 years, and a risk premium for tying their money up for 30 years in case interest rates went up and they've locked in debt too low. So there's a risk that they're going to lock it up for 30 years at 1% and miss out on better returns elsewhere. So for them to be locking it up at 1% means that they're not seeing any inflation in 30 years. They're not seeing any investment where they can get a return better than 1% in 30 years. That's safe. That's why the money's going there. That's hardly predicting any inflation. That's predicting deflation. In fact, I'll show you one other chart. We'll have a look at, because gold's only one commodity, but what's the CRB index doing? Which is a whole basket of commodities. That takes into account food, agriculturals, energy, all of it. Thomson Reuters Commodity Index, there we go. Okay, well this is the benchmark commodities index that everyone quotes and looks at. And it's gone from 470 something, 474 down to about 100. And according to my measuring tool, I'll just get this over here, we can see everything. According to my measuring tool, since 2008, it's devalued 78.8%. 78.8% decline in commodity prices since 2008. Gold's rallied since 2008, by the way. It's rallied at 92% on the US dollar. And yet, the US dollar has devalued the rest of the commodities by 78.8%. And why is that? It's because gold is not trading like an industrial commodity. It's trading as a currency. And it's trading as a currency that's not being debased. And so gold is pretty much one of the isolated commodities that's been able to appreciate through this period. It possibly is the only one. So all of these charts are telling us something fundamental. US Treasury bonds have crashed. Commodity prices have crashed almost 80%. We're about to head into a recession before we got the coronavirus. We've got the Philadelphia and the Atlanta Federal Reserve predicting a second quarter GDP of something like minus 40%. And the media's not even reporting about a financial problem. We're only reporting about a medical problem, being a coronavirus. I tell you what, if we haven't got a financial problem, I don't know what is a financial problem. Our financial problem is deflation. We've been fighting it since the GFC. All of the fiscal stimulus programs that the governments have undertaken, with their fiscal deficit spendings, and all of the monetary policy easings, the interest rates have been dropped to zero all over the world. We've done more money printing than ever in existence, and we're still heading into deflation. I'll tell you why the central banks around the world are fighting this. Because it's the scariest thing for a central bank is deflation. And I'll tell you why. Let's go back to this chart. What happens if 10-year bonds start to go negative 1-2%? Well, the 90-day yield's not going to go to minus 1 or 2%. What's this going to do? The 10-year yield is going to stay under the 90-day bill in an inverse yield curve. In an inverse yield curve, it discourages borrowing for investment. In a normal yield curve, when you can borrow short-term at a low rate and invest long-term to get a higher yield, it encourages borrowing and investment. But when the yield curve inverts and you've got to invest longer term for less return, there's no incentive to borrow at all. No one's going to borrow and no one's going to invest. Everyone's going to save. And basically, when you've got, say you've got minus 3% inflation, if you've got zero interest rates, or even if you've got minus 0.5% interest rates, you can't have minus 3% interest rates. I'll tell you why in a minute. But if you've got minus half and you've got 3% negative CPI, that means you've got 2.5% real interest rates and an inverse yield curve. That is not going to bring an economy out of recession. That is a tight monetary policy. So monetary policy has only one arm left, and that's quantitative easing. That's all it has left. As far as fiscal deficit spending, that's not on the table, because when you've got deflation, you've got rising unemployment, falling wages, companies left, right and centre filing for bankruptcy, you've got banks needing bailouts, you've got defaults on mortgages, you've got businesses defaulting all over the place. Right? In that, you've got corporate profits shrinking, you've got tax revenues shrinking. There's no taxes coming in, so there's no balance sheet to work with for deficit spending, so that's not on the table. And the printing becomes really dangerous, because if you try and print your way out of a deflationary recession and you do overprint and you start having inflation, then you've got inflation and negative GDP growth. That's stagflation. We saw a little bit of that in the 70s. That's even worse, because then if the central bank doesn't lift rates when the economy can least afford it, if it doesn't lift rates to contain inflation, then inflation can run away into hyperinflation, and that's when you get the situation that has happened time and time and again in Zimbabwe, Argentina, Germany after the First World War. There's been countless times we've seen this, where central banks have tried to print their way out of these things and end up causing hyperinflation. They debase their currency and they basically lose their sovereignty. And that's the worst thing they can do. And that's not something, I don't think the US Federal Reserve would ever take that route. They'll be more responsible than that. When you go into deflation, usually there's not much policy is able to be used to pull it out, to reverse it. Very limited can be done. And that's why the central banks fear it so much. They saw it happen to Japan in the 90s, and it scared the life out of them. And they don't want it to. They don't want to see it happen. But the thing is, when you've got the commodity prices crashing like this, oil went negative a month ago. They couldn't give the stuff away. There was that much of a glut of oil that everyone couldn't store any more of it, so they were paying people to take it off them because they couldn't store it. They couldn't take delivery of it in the futures market. We live in crazy times. And you have a look at, go back to that bond market. There we go. If this thing keeps going, well look, up until now, the Federal Reserve has been able to follow down the bond yields with the Fed funds rate. Now, if these bonds now flip into negative territory, the reason why negative interest rates don't work is this. Let's say the Fed funds goes to minus a quarter, and you'll probably still leave your money in the bank or put your money in there, and you'll lose 0.25% a year to know your money's safe in the bank. Or is it safe? But at least it's relatively safe. If it goes down to minus half, you might still say, yeah, I'll just cop 0.5% a year charges to have my money there. If it goes to -1, -2%, are you going to leave your money there, or are you going to go, hang on, why am I leaving it there for them to charge me so much? I'll just keep it in my safe and it won't lose anything. Or let's flip it round and look at the other way. So let's say the Fed funds was minus 5%, just hypothetically, if that was possible. And let's say that the home loan rate was minus 2%, the floating home loan rate, or the variable home loan rate, whatever you guys call it in the United States. We call it the variable. I think you guys call it the floating. And let's just say that the floating home loan rate was minus 2%. So that means that the bank's going to give you money to go and buy a house, and then they're going to pay you 2% for the privilege of loaning you the money. There's no mortgage payments. They're going to pay you for having the money. Do you think the bank's going to do that? Seriously? No, they're not going to do that. They're just going to keep their money. So that's why negative interest rates doesn't work. It's a window dressing. Effectively, you can't really do anything with negative interest rates. All they can do is try and match the bond markets. But if everyone's too scared to put money anywhere else, and they think they're going to, they might even be prepared to lose a little bit on the bond market. I suppose speculators will take a negative yield because they're speculating it'll go further negative. And because prices trade inverse to yield, there'll be a boom in the bond prices and the speculators will be chasing the rally. That's probably why they'll invest in negative bond yields. God only knows what makes mass psychology work, but bond yields can and do go negative in a depression. At present, all of the evidence is pointing to deflation. There's nothing pointing to inflation. The argument that gold's going up is not an inflation argument. That's just simply a reflection of the fact that it's a pure currency that isn't being debased. You can't print gold. Therefore, it's got to hold value against all the other currencies. And there's no disadvantage in holding gold anymore as a zero coupon currency because you can't get better interest rates on the US dollar. You can't get better interest rates in Europe. So you might as well hold gold. You don't lose. It doesn't matter. You don't get any interest. You don't get interest anywhere. That's another reason why gold has got a lot of ticks at the moment. And there's no saying that in the long term gold isn't going to keep rising, because it is most likely that currencies are going to keep quantitative easing, at least for as long as they can, and that's going to favour gold to keep rising. We should just go back to finish this, and if we just go back and have a look at the daily chart on the Dow ETF, because it's been a few days since I did the other series and the market's done something, not a lot, but it's probably worth, I thought daily, yeah, daily. Okay, that looks better. Just expand that. Okay, you'll recall in the earlier session I was talking about a likelihood that they would break this resistance to find the stop losses simply because there was no volume in here, and just to complete that last little three waves on that, on the fifth wave of that diagonal triangle, it's a 3-3-3-3-3 pattern, and to hit the 0.618, which I talked about, which had almost exactly hit in yesterday's session. The market's closed right now, and this doesn't trade, this ETF doesn't have extended trading, so it's not trading at the moment. It'll probably hit that tonight. It could go to the top of there, like I've drawn there. It's in the region where I think it's in the real danger zone where it could start a heavy sell-off. I'm just saying, watch it. Volume did spike up a little bit. Not enough to say that it's definitely peaked, but it did run some stops. So it's sort of the best volume we've seen in about a week, yesterday. And what should happen now is, as we start trading down, we should see volume continuing to expand. And as I've been saying, if you see a close under 230 on a bearish candle, 23,000 on the Dow, this thing's quoted at about 100th of the Dow, this ETF, and you see volume going back to the round about the levels it was trading around in March, then you can be confident that that's the start of the impulse wave, and that's potentially a third wave of the first 5 waves down of the A, of a bigger ABC of the triangle, and that's, I'm projecting that as low as around 8,000, and that's given that's 25,000 at the moment, that's almost a 70% devaluation in the Dow, and that could happen as early as late June, July. So just be on the lookout for that. This whole count is based on my hunch that this is going to be a triangle and not a flat correction, because we have to alternate with that zigzag that happened in the 32 crash. And my hunch is that it's going to be a triangle, which means that the A wave is going to do the most of the damage down to 4,000 by around 2023. However, it could be a flat, and if I need to revise my count, a flat means that we'll make a double top still before we start the down move. But in any case, at the moment, this is my favourite count. This is what I'm looking for. I'm looking for a close under here on high volume. Say volume at least as high as this, which was over what are we? I'll just grab that. I'll just get the volume visible. So on the ETF, it was 7.5 million. Yep. So yesterday it was 4.87 million. So I want to see volume of 8 million plus as we close under 230 on the ETF on a red bearish candle. You want to see the close below halfway on the range to be decisive. Good luck with trading and good luck with your investments, and I hope that you've gained something out of these videos, and I'll update as required. If my long-term counts, I see it unfolding with more evidence, I'll do an update. If I have to revise, I'll do an update. If you want to keep seeing what I've got to say, just hit the like button, subscribe, whatever. Thanks for tuning in, guys. I'll see you guys later. Bye.